Hello, I'm Tony Kaye. Welcome to the Economic View. I'm joined by Evan Lucas, our market strategist.
Hey Tony, how are you?
Yeah, very good, Evan. Look, the Reserve Bank's kept interest rates on hold again. No surprises there. What is a surprise is some of the changes they've made in their statement today. So just wanted to talk about those and what it means.
Yeah, you can hear the teeth that Martin plays really grinding through.
You're surprised.
Yeah, because the statement, and I deliberately printed it out to go through it because it's a big change. Like normally there's a handful of sort of red lines through X, Y, Z, and you can go. The statement has changed quite significantly, and I think you therefore need to really go through it. I think what's going on in the second part of the statement, wage growth remains subdued in most countries, as does core inflation. That's all new. Headline inflation rates have declined recently, largely reflecting early declines in oil prices. That's all one time. But what the bank's really pointing out is that things are much lower than what they expected in terms of that inflation number. But it then goes on to say the bank's forecasts in the Australian economy are largely unchanged. So that means, therefore, that they still believe that GDP growth is still going to be 3%, and they clearly state that here. They believe the transition away from mining towards things like oil and also services are on track, and they allude to the fact that business conditions are relatively strong, that you've seen actually a pickup in employment, and they actually, looking at the second page, expect unemployment to tick lower. But at the same time, they've also said in that same statement, against this, however, wage growth remains low, and this is likely to continue for a while yet. Now that gets back to the inflation point. So the reaction in the Aussie on the release was, as you'd expect, as I said, the jaw clenching was there. Talking about that exchange rate, and I'm sure we'll come to it in a minute, it fell away. But the fact that they haven't changed their core inflation mandate idea, which is around 2 to 3% in the foreseeable future, the fact they see growth there. If you have a look at the 5-year bond rate, went up. If you have a look at the Aussie dollar, it's holding above 80 cents. So that's the interesting thing. So the question therefore becomes what they've talked about the Aussie dollar and what's in there. It's probably a bit weak for trying to actually really move it lower. And that's the interesting thing. So they do acknowledge the fact that the Aussie dollar has appreciated recently, partly reflecting a lower US dollar, which is all well and true. The higher exchange rate is expected to contribute to subdued price pressures in the economy. Now that on itself would suggest that if it was to hold above even 77 US cents for a foreseeable period of time, that their 3% GDP figure will come under pressure. Considering that a lot of the reason GDP has been quite strong, if you look at the terms of trade, the exchange side of the E and the I has actually been positive, and it's added to GDP. If all of a sudden you had a price pressure from an FX headwind, that'll really hit GDP, which is one thing to note and quite interesting. It also then, and this I think these two sentences are probably the strongest, it also weighs on the outlook for output and employment. An appreciating exchange rate would be expected to result in a slower pickup in economic activity and inflation than currently forecasted. So there it is. So at least they acknowledge that the exchange rate is a bit of a problem. So they are therefore very much now on the hook to December with the Fed. If the Fed is unwilling to move rates in December, then there is a real question about whether or not Australia can actually reach the RBA's forecast of 3% GDP, whether or not, therefore, wage inflation, which they do acknowledge is really stagnant, goes even further, and whether or not the unemployment rate starts to tick up. So all those factors are now coming into the back that today's result clearly shows that the RBA is worried about the exchange rate, that they're probably suggesting that they really don't have a mechanism to pull to help you in that scenario either. And it will therefore filter through into what happens in the market. So it'd be interesting to see what happens in resources over the next couple of weeks.
Yeah, absolutely.
Even though we've got earnings season, if you were to see this become a trend, the bullishness in the short term for commodity prices will dissipate on the back that the exchange rate is now a headwind. So really interesting statement.
Yeah. We're so used to the Reserve Bank doing very minute changes in their statement for month after month, and then this statement has got quite a lot of change. So obviously, they're quite worried about some of these headwinds.
They are indeed, and as I said, like it is, and having a look at it over the 2 pages that's here, it's substantially different. It's had an extra 2.5 paragraphs put in, and they are changing their view on terms of where things sit. So inflation, as we've been talking about in these programs for the last couple of weeks, is the buzzword, and it's clearly part of all of what's going on inside this statement, is that inflation is likely to remain below trend, and they do highlight that. That's what they forecast. But the impact also of a higher exchange rate on wage growth, on employment, and therefore output is also another layer to the inflation story, and therefore that growth forecast. So there's a lot of intrigue in that, and there's probably why the market's a little bit unsure. And as I said, the Aussie is actually moving up on the back of it because it almost does say to you that the RBA is probably out of the market, and they don't have a mechanism to try and lower the exchange rate. So they are basically letting it organically move the where it needs to move to. And the story is a weak US dollar story, and that's what we've spoken about before, and a better commodity story than probably was forecasted in the cycle. And again, the statement alludes to that. So the Aussie dollar is on its own, and it's a perfect storm for it. And the perfect storm at the moment is actually to the upside rather than to the downside.
Yeah, which goes against what some economists have been saying. They've been expecting the dollar to fall. They've been expecting, some have even gone as far as saying rate rise on the cards for later this year.
Yep.
Very unlikely.
Well, look, I actually, with that, and the last statement is a really interesting one, that looks like headline grabbing to me. I've seen those two investment banks. I'm not going to highlight who they are, but they were really bullish on a lot of things and were almost basically saying, don't worry about inflation. They're clearly going to worry about housing and the fact that business conditions are really booming, blah, blah, blah. They're going to want to get out of there because they're a hawkish position and they want to have some ammunition in their back pocket if things get really bad. The argument on the other side is inflation isn't there. And second of all, they've got ammunition. 150 basis points is still okay. I mean, yes, it's the record low rates, but we're not like the ECB. We're not like the Fed where we've got rates with a zero handle. With a zero handle, BOE, etc. We're one of the only banks, along with the RBNZ, that actually have a one handle on our rates. So there is cushioning there. And I think what's coming out at the moment is that the RBA will probably not move rates at all for at least the next 6 months. And I'd even be confident to say that even to this time next year, so we're talking 12 months away, the probability of a rate rise will be below 50% all the way through then, because it's just not materialising the way they want. And raising rates and the effect on the Aussie dollar and the cyclicality that's been GDP because of exports, all of those sort of factors just give you a reason to believe that the RBA is going to pause. So unfortunately, it gets back to the theory. The Aussie is an organic mover now, and it's a US dollar story, and what the US gets up to is where the Aussie will go.
And what the US gets up to is anyone's guess.
At the moment it is, because, again, looking at what's been coming out from the US data, it's reasonable in certain pockets, but not all working as a unit. And because of that, because of the personality that Janet Yellen is particularly, and the fact that the voting members in the main are either neutral or probably to the dovish side, that they'll probably err on the side of caution rather than possibly moving. So it's why December is just becoming less and less likely, because inflation isn't coming around anywhere near what they need it to. And it is part of their two mandates. Yes, employment's probably full over in the US, as full as it can be. Inflation's so far away, it's not funny. So that mandate's just enough to say, right, we've actually increased rates by 3 times in the last sort of 18 months. Let's filter that through. We've always said this would be a gradual return to normalisation rates, and gradual gives them that mechanism to say, actually, we're not going to raise rates again at the current point. We want to see inflation come to us before we start to tighten policy again and normalise it. So it's the interesting factor that unfortunately us here as a following economy are just going to have to put up with and sort of work around when we can. Yeah,
we'll see what happens to the Aussie dollar over the next few weeks. We'll see what the Reserve Bank says in addition.
I agree. So probably even the next week is going to be very interesting to see whether or not anybody actually believes what's come out of this statement, and whether or not they've come to the same conclusion we have, which is that the RBA is on the sidelines and basically telling you that it doesn't have the ammunition to do anything, and therefore we are beholden to the Fed rather than to the RBA.
Well, great. Thanks very much, Evan.
Thank you very much.
Good to talk to you. Join us again on The Economic View.
At InvestSMART, our mission is to help millions of Australians to protect and create their wealth. This is why we now offer a life insurance comparison service. All you need to do is answer a few questions, select your cover, and compare the results. This quick and easy service provides quotes with up to 9 of Australia's leading insurance providers. You can compare the benefits of each insurer with our easy-to-use comparison feature. We have a team of qualified specialists who can answer any questions you have and make the application process as smooth and easy as possible. For more information, visit our website or just give us a call.